We are ready. Session number 1 of Elevate is about to begin. All right. So, this first session, Fundamentals of Investing 101. We're going to break it down. We're going to understand what is investing, yes, but how to win at it and when to panic and when not to panic, and to understand all of the basic fundamentals. As you know, we have a fantastic panel of people who are going to be breaking it down, and I'm going to introduce them to you right now. They're going to join me on stage. First of all, if those of you who are on Twitter, social media, any at all, especially Twitter, or you read the Jamaica Observer, he is a noted investment analyst, investor himself, and business journalist. I think he's still single, but we'll check that out soon. Please welcome Mr. David Rose. Big him up, man. You want to hear the big applause? Big applause. Hey, David. All right. All right. We have a lovely lady who is going to be among the men on our panel today. She knows our stuff, right? Profit Jumpstarter. If you're on Instagram, please to go follow her. Profit Jumpstarter right now. She is a wealth coach. She bright. She have Olipa degree and Olipa certification in investing and maths and analytics and research. She's a former JMMB team member before she went on to do even better things. And she's just passionate about helping people to understand how to make themselves wealthy or wealthier. Please welcome Keisha Bailey. Woo! Hey, Keish. Locks them pretty to them, man, them pretty. Yeah. All right. We're going to fall in love with wealth today. And then finally, Peter Thompson, who is our group client investment manager. We love Peter. When we come into marketing, we just time up and hold him down and just take all the knowledge out of him brain, because the man know him thing, him know him investing thing. And he's passionate too about educating people. He's also a teacher as well in his spare time. Peter Thompson, welcome Peter. All right. So Peter is married, but David, what's the marital status? My team is telling me to shut up and sit down, Carrie Ann. Just shut up. Okay, and David giving me the eye. David knows that I love him and I have his best interest at heart, right, David? Oh man, love you, David. All right, so let's get started. All right, well, we have the question. So Peter, let's start with you. And we're going to try and keep the answers as tight as possible because we have lots of questions and we want to make sure that everybody gets their questions in. But for Peter, let's start with you.
Yeah.
For anybody who is brand new to investing, right? And we have some folks here. Could you tell us what is investing and how is investing different from saving? Because a lot of people mix that up. They think it's the same thing and it's not.
All right, and Elevate 5. All right. All right, I'm excited to be here, guys, and I think this topic is quite interesting and relevant at this time. All right, so investing. At the base level, investing is you're buying an asset, long and short. You are buying something with the aim for that something to earn and be more valuable in the future or be providing some form of income. Savings is, at its base level, you're lending money to a bank. So each time you get paid and you decide to put away some, you're really lending the money to the bank, and the bank will say, okay, at any time you want this money, you can come and get it. The money in your checking account, that money is called demand deposit. On demand, you can ask for that money. You go to a supermarket to swipe your card, money comes out of that checking account. Your savings account, a little bit more stable, as in it stays a little bit longer, but that money is there. On demand, you can request from your bank that they pay you back that money. Now, the returns, of course, that you get on your savings will be small, because that money, at any point in time, you can ask for that money. And as such, the difference between savings and investing, savings is literally short-term money. You do not expect a significant return on your quote-unquote savings. Investing is where you're putting money, you're buying something, you're buying an asset. That asset, it could be stock, bonds, real estate, whatever, but the objective behind that is a return. You're hoping to earn either income from it or the value of it goes up. Long-winded, but I think I got there.
No, man, I think you got it. So you're saving with typically your bank and your credit union,
Correct.
with your checking, your savings account, your CD, your certificate of deposit, investing now with like a securities deal or through a broker. You get stocks, there's bonds, money market instruments. So we're going to break it down a little further, but it's important to understand that distinction, guys. David, I want to hop over to you because someone asked a question here earlier. What is an investment portfolio? When they talk about investment portfolio, what that mean?
So your investment portfolio, is just the collection of your investments. So that can be, financial securities, so stocks, bonds. For some persons, that might be the house they live in. And, for other persons, that might include other non-traditional assets. So for some example, in 2012, when we had our 50th anniversary, Appleton actually released a 50-year collection barrel that was being sold for, at increasing value over time because limited edition, it's a rare item, and that's just one example. So when you're about an investment portfolio, persons traditionally think, oh, it's my stock portfolio, but no, it is much more dynamic. And what's in that portfolio, it depends. So for example,
All right.
this is from Trinidad, by the way. Yeah, the big JMMB is right here, by the way, as well. So
Yes, there's a logo.
And you see the stocks, the shares, the price, the market value, and what percentage it makes of your portfolio. So some persons say for their portfolio, they want to have like, to say 40% in stocks or equities, let us say 30% in, fixed income, and, about 30% in cash. And it all comes down to what you need to do and what your goals are. But that's really what it is, what do you own? And, those assets don't have to be what you call restricted to just what you can see at the moment. Can also be intellectual property.
I love that. So it's really just a collection of the different types of investments put together that make up your portfolio. I love that. And when we talk about diversification, it's how many of the different things that go into that portfolio. Because some people think, oh, stocks is my investments and that's the only thing. That's actually not the way to go, right? You don't want all of your investments to be in stocks. You want it diversified. You want it in different types of things, whether it be stocks, bonds, real estate. Keisha, based on David's response, could you kind of give us some insight into how do you combine, how do you know what I should have in my portfolio, combine the different investments in my portfolio based on age and stage? Because we look across the audience, and I know we have tons of folks watching online, and we come from different backgrounds, we're different ages, we have different risk appetites, we're going to go into that in a minute too. But how do I know how to combine those things all together to really make my portfolio?
So the way I look at it is like a plate of food, right? And everybody's plate of food is different because everybody has different tastes. Now, depending on think of it now, buffet line, where there are some people may say, give me some rice, chicken, veg. Some people may say, I only want veg and chicken. There are different choices that are made. The plate is your overall portfolio, but based on what you are looking for, your plate is going to look a little different than Peter's or mine or David or even Kerry's plate. It's going to look different. So depending on what you want, say, you're on a diet, you're looking to cut back, you're going to say, give me mostly veg, right? So you're going to pick those types of investments that are lower risk, and so because that's what you're looking at, you want to cut back. Somebody may say, well, looking to gain some weight, I can put on a few pounds, then we want whole heap of rice, whole heap of potato salad and yam. So they're going to look for more growth type investments, the heavier stuff. Some people may say, I'm vegan. They are looking for a specific type of investment for that. So depending on what you're looking for, your plate is going to look different from mine. And that's the essence of diversification, portfolio construction. The younger you are, you should be looking to grow the money more aggressively. So you taking on more things, right? More carbs, because you want that growth. As you get closer to retirement, you're going to find that, maybe I need to dial back a little because I'm going to be needing this money soon. So you switch into, the low carb plate, and you start looking for safer type stuff, lower risk kind of stuff. If you're looking to buy a house, you may be looking to save specifically for the deposit or save to help you for closing costs and so forth. So that's how I think about it. I think it's helpful, you know, what my plate look like. Your plate look different depending on where you go also, you know?
Love it. I love how we're breaking it down and making it nice and simple to understand, and we're going to keep going. So, Peter, we spoke about risk and different types of investors because, first of all, is investing a risk-free activity?
All right, excellent question, Kerry. All right, so investing at its core, and remember what I spoke about, you're actually physically buying something. So those things, the price of those things over time will change. There are things that the price will not move. You're almost sure that you'll get back your money. Those things are risk-free assets. So the universal risk-free asset is U.S. government borrowing. So when the U.S. government borrows, everybody across the world expects that you will be paid back, right? And as such, that is seen as a risk-free asset. Yes. So can you imagine when they say, okay, they're going to default on their debt, it causes pandemonium in the world. So the universal risk-free asset is when the U.S. government is borrowing. So governments across the world, they're borrowing in their local currencies risk-free also. So in Jamaica, the government of Jamaica, each month when they borrow, that is seen as risk-free.
Yeah.
Everything else has some level of risk. So when you buy a stock, you are literally buying a piece of someone's company. That's what you're doing. It's not a lot of ticket you're buying. You're buying a stake, a small stake. Some of us may buy a bigger stake, but you're buying a piece of that company. So the value of that company will change. Now, over time, if the company continues to earn and pay dividends and it doesn't go out of business, then that's where your value is. But on any given day, if you decide that you need to sell your stake in the business, if it's a publicly traded company on the stock exchange, there's a price. Somebody out there is looking to buy it from you. The price at which they're looking to buy it from you is what you see every day. Now, you decide whether or not that is your price. So you may decide, I'm not going to sell at that price. So the person, that up and down value that you see is different people out there saying, I feel like this company's value at $1.50. You bought it at $2, you're saying, I think it values at $2. So that $1.50 that you say is just someone's wish. They would love to buy your stake in the company at $1.50, but there's no rule that says that you have to sell that. So the value of these things change. So investing in a company is risky from the point of view that if the company goes out of business, then your investment goes out of value also. There are other investments, companies borrow all the time. So you have strong companies who are out there looking to borrow money in order to finance their growth. That is a loan you're giving to them, and that's called a bond. That loan that you've given to the company, the value of it will change also, but even more importantly, you lose money if that company says, hey, I cannot pay you back. That's how you end up losing. But before you buy it, you're going to look and say, can that company pay me back? I'm going to look and see, is their business model strong? Do they have enough earnings to pay me back before you lend them? Just like if you're lending your friend. You have two friends. One of them, they're living day to day, paycheck to paycheck. And then there's one that's more stable and they need some short-term borrowing. You're going to decide, so, okay, do I lend to frivolous Susie or do I lend to stable Kerry, right? So you decide. When you lend to frivolous Susie, there's a higher probability that you may or may not get paid depending on whether or not there's a party that week, right? So you have to decide which one is more risky. But at its core, bonds, whenever you hear the word bonds, you're lending money to somebody or a company or entity. You are looking at whether or not that company can pay you back. When you're buying a stock, you're buying a piece of a person's company. So the value of these things change and they involve some amount of risk. But once you do your homework, losing your money, it's not like gambling, right? It's a structured, regulated type of process.
Yes, and so it's a very important question you have to ask yourself first and foremost is if I'm investing, how much risk do I want to take on?
Correct.
And I mean, stocks is probably the riskiest investment out there, among the most risky. And then a lot of people go into stocks not recognizing the amount of risk that they're taking on. Obviously, you have different companies that have different
Correct.
stocks. There are some companies that are more stable long term. You kind of know them. Some that are newer, you don't know them as well. And so it's really important to ask yourself how much risk I want to take on. David, I want to hop back over to you again. Could you just kind of give us a sense of high level, what are the different types of investments available? I know that could be a long answer, but in as tight a way as possible, could you share with us the different types of investments that are available that folks can invest in these days based on your understanding?
So you have the generally accessible publicly available investments. So, in the case of the JSE, the Jamaica Stock Exchange, you have securities that are listed there, some stocks, you have bonds, preference shares. Then you have, those private investments, such as, for example, private placements. You have a company like a JMMB, which offers a unit trust. You have different institutions which offer, as you would say, specialized investments like receivable financing and so forth. So the thing is, when it comes to different types of investments, it comes down to what's available based on the amount of capital you have as well. So for those who don't know, there are investments that are restricted to what you call accredited investors. And in our legal definition, that means you earn at least $10 million in income over 2 calendar years, or you have at least a $50 million net worth. So for most people, we're restricted to the public side. But the thing is, if you know somebody, you might get you. So other day somebody in Trinidad, said, send me a document. I'm like, all right, thanks. And, I walked up the road, went to a broker here in Jamaica, I got into that offer. And December 30, I saw, wire transfer. I'm like, oh, Zine? No, not that. I just did. Like, I just want kind of perspective. And, if you go outside of Jamaica, for example, you have exchange-traded funds. You have, for example, options. And, the spectrum continues to increase. But it's really restricted to what's available in your jurisdiction and also the regulations in that space, because I mentioned, accredited investors. So that kind of helps summarize it to an extent.
Thank you, David. So we got stocks, we have bonds, we have
ETFs.
unit trusts,
ETF.
ETFs, exchange-traded funds, which some people may not really be into that. I mean, we're getting more complicated as the terminology goes along. But there are different types of investments, and I guess if we wanted to break those down, we encourage folks to definitely have a conversation with an advisor who can explain the different types. But Keisha, hopping back over to you now, for those people who I have so many questions here, guys, so forgive me, my head is down, I'm talking to you. It's not that I don't have no manners, I just want to make sure I'm covering everything, right? And you see my alopecia that I'm struggling with at the top of my head. So Keisha, for those folks who are just starting out, right? What are some of the key things that they need to keep in mind, because even for some of us who maybe have been investing for a little bit, some people it's their first time, some people may just be kind of dipping their toe in the swimming pool, they're not really jumping yet. What would you say are the key things that a first-time investor can keep in mind when they're investing, when they're planning for their financial lives?
First things first is know why, know why you're investing. It's not just about, all right, let me just put in some money in a something, but why are you putting the money in something? What is the money going to do? Because money is a tool. Your plan is to grow that money to be able to do something with it. So you have to first come back to, all right, what do I want this money to do? I want it to buy a house, car, retirement. I want it to take care of my children, take care of my parents. Once you know that, we put a number behind it. How much money is that going to cost? And then we work back to, all right, I need to go into my advisor to have a discussion about what kind of investments do I need to have to take me to that goal? Because I know how much it's going to cost me now. Let me go and talk with an advisor to find out exactly what are the right investments that I need to be putting my money in. After that, consistency comes in. We have to regularly put money into that investment. Not start today, stop next week, come back 3 months' time, but every single month, whether we're doing standing order,
Machine con, Keisha.
the consistency is important. That's where a lot of people fall down. Because, you know, life happens, we're busy life in it. But we have to stay consistent. We can use the technology to our benefit. Set up your standing order. Make sure you're putting your regular contributions to your investments. If you keep doing that, you are going to reach the goal. And that's what we all want at the end of the day. We set up ourselves from the beginning to know what we want our money to do. And then because of the consistency and putting our money in the right investments, we get to the goal. Everybody happy. Legacy bill, generational wealth bill, that's what we want. So that would be my path to make sure.
Keisha, I want to pause here a little bit. Well, you finished, thank you. But I wanted to pause the flow of the discussion here because we get this feedback all the time where we say, okay, speak to a financial advisor, get the understanding of the different investments based on how much risk you want to take on, and then you start out the investment portfolio. But then the question then becomes, what is the role of my financial advisor thereafter?
Ooh,
because when
yeah.
we talk about like investing in stocks, for instance, and again we hear it, my advisor don't call me to tell me which stock to invest in, and she never called me to tell me when to sell. And I think it's, remember me hear the clapping. Thank you. So yes, so we're listening, guys, we're listening. But you know, it's a question because what is the role of your financial advisor vis-a-vis versus your role as the investor? Is it that how much control should I be keeping for myself or managing for myself versus expecting my advisor to do? It's a real question based on just how investment companies are in Jamaica today.
Kerry, can I add to that quickly?
Yeah.
Sorry?
Can I add to that? Can I
Sure.
add to that? So,
Add to the question?
no, to what you're discussing, you know.
Okay.
So, so the thing is that while persons say, my investment advisor tell me this or that, it all comes down to, you know, what's agreed upon in the relationship. So for context, some persons, you know, have a managed account to the advisor where the advisor, you know, is required to inform their client that, hey, this deal is coming up, could they have the permission to actually do this? You know, it's a partial discretion. And, you know, for other persons, the advisor is somebody you check up on like on a holiday time, and, you know, you have the time to go and see them and say, hey, this is my portfolio, this is what's happening, should I adjust here or there? So the relationship exists, but at the same time, person needs to understand what role the advisor plays with them. So is that, are you going to be buying the stocks on your own? And do you need that check-up in a sense of, all right, do I need to rebalance? Is there an offer coming up? It has to be defined. You know, it cannot just be advisors tell me to do this, that, and forever. We're a parent sent to school, we learn something, and, you know, we learn to turn shoelaces, and, you know, we continue to improve. And it has to be, you know, a balanced relationship. You cannot just be advisor, call me every time when something happens in the world. They have multiple clients, and that is why I said if it's a manager portfolio, you get a more personalized touch.
Yeah.
Thanks,
So
David. I want
jump in.
Keisha to just hop in,
Yeah.
and then Peter,
So-
you
No
look like
problem.
you're itching too.
And
Good.
then, yeah,
Go ahead,
you can,
Keisha.
I will tag team with you.
It's a
I'm
hot
gonna send
topic,
Peter
hot
up
topic.
here. So first question is, whose money is it?
Yeah.
Whose money is it?
Exactly.
Your money, my money. All right. So it's your money that you have deposited to the institution to say, you know what, I'm being consistent, may I build wealth, I want my dream house, I'm putting my money in my investments, right? Your money. Now, Peter is the manager of that money. That's what he does every day, and he's very good at it. I know because I've worked with him and I see him, know him thing. So he manages the money on your behalf. If Peter is not doing a good job, what should happen?
I move on.
Draw him up, right?
Exactly.
Draw him
You
up.
call him because it is your money, it is your right. You call him and you can get him or someone from his team. And you say,
Right.
look here, Peter Thompson from JMMB. I have some money in one of the unit trust products. What is happening to the performance? Because your money. If it's short for the goal, are you going to get impacted? Peter is managing the funds for you, and he's very skilled at doing that. But if it's not meeting the return that you want, call him. He is going to be able to discuss with you what is going wrong. He may say, well, you know, it's 2022, this happening, pandemic, that, but don't worry. You know, I know the right strategies. I'm highly trained, highly skilled. I got this. We're going to make the performance better. And you can say, well, yes, all right, thank you, Peter, for that. If you can't get Peter, you call your advisor and say, same thing. What's going on with this unit trust, this investment? I need to talk to Peter. I can't get him. They will find Peter and ask those questions for you. But it's your money. It has to be your responsibility. A lot of times what we do is we say, all right, we'll put the money, you know, we give the money to the bank. It's still yours. It's just deposited there. We have to protect our money because it's ours. We owe it to ourselves to ask those questions from the advisors because they will answer. If you don't ask, you're not going to know. But because it's your money, you have to protect it. That would be my answer. And I want everybody here to think that way because that's how you protect yourself, because your money.
All right, ma'am.
I appreciate that. And Peter, I know you're going to jump in.
I'm ready to jump in.
So remember, guys, Peter works for JMMB. Keisha does not. But, but Peter, we love you same way. But anyway, Peter, as you're jumping into, I'd love for us to kind of just expand this conversation to include a question that we had penned for you, which was, what are the top 3 tips someone should know when they're investing? But start off and just give us those top 3 tips, please.
So it's a nice good segue, right? All right, so Keisha spoke about the concept in terms of your role. And I think David also kind of put it in context. The first and foremost, the first part of the conversation is that you have to understand why you're investing. Keisha touched on that, which is key. Because depending on what your objective is, that will determine how frequently you actually have a conversation, right? So, and there are different type of investors. You could be an investor who your core thing is that you want to live your life. Your job is not to figure out which stock is the best stock to buy. You don't have the time for that. You specialize in being a doctor, lawyer, police, or chief. That is your job. There are professionals whose job is to do something else, to do that management. So we build a team. And just for context, so it's a team of 5 people, not 500 people. In terms so what happens, right? What happens is that each advisor, we arm them with because if you think you ask your advisor a question, you should see how the advisors ask us questions, in that every day they're on the phone. What's happening here? What's happening? So what we did, we've kind of have conversation, our structures where we tell them what is happening, what's the method to the madness, what we're mixing up around the back there. Why is this happening? So they are armed with the knowledge to answer your questions. There are cases in which it gets escalated all the way up. But the thinking is they are armed with it and they're able to help. But the minute you understand what you're doing, so step 1, you have your emergency fund tucked away. That's in a bank account somewhere with a bank. The minute you're in an investment account, you're now thinking of buying assets for some objective that is either medium or long term, not for emergency, because you don't invest for emergency.
Right.
You save for emergency. You invest for medium to long term goals. The minute you have that, the conversation now comes in. You agree to do X amount of things. You are going to put down X amount of dollars every month. They are quarterly checking. You get your statement and say, wait, this is off track relative to where I want to be. You make a call. What is happening there? And an answer will be provided. If it's not on the statement, by the way, to kind of explain what's happening. The step 2 is that on an annual basis, life happens. Things change in your life. This is where you come in again and you say, okay, when I started this thing, I was single. I'm now married. The husband said that he wants kids next week, type of a thing. So now we start planning. So the concept changed, because now we have a plan for a smaller human. So the objective, that's where you come in and talk to your advisor and say, okay, you know what? This has happened. and then you rejig, and it's okay, we need to redo the numbers. What that discipline does is that it allows you to sleep at night knowing that, remember when I pointed out that stocks, the prices go up and down. So your portfolio, the value of it is going to look like it's going up and down. And if you see that up and down and panic, and you say, okay, I want out, you're just selling your asset to somebody who's saying, okay, I know everybody's panicking, let me just throw in some weird price and buy it from them. So if you panic, you're selling your assets cheaper than what they're really valued at that time. But if you have this long-term objective where you say, I know that now is not when I need the money. I need the money 5 years from now. You can rest easy knowing that it's going to go back up, right? So it instills that discipline in it. So the top tips, I would say, in terms of investing, and I think it's in line with what Keisha and the team has been saying so far, is that know why you're doing what you're doing, as one. There is, when you come to me and say, okay, you're investing, what's your objective? I just want money. Okay, you know, there's different ways to earn money. You can go buy a lotto and in that strategy to earn money, but then the probability of you making that big money is low. So when you say you want to make money, I need to understand how long you want to invest for, the amount of risk you're willing to take. Because as an investor, I need to understand who you are, because you have conservative investors, call them the vegan investors. I'm borrowing that.
You're running with it, the vegans.
The ones just eat vegetables, nice, boring vegetables, right? And then down the spectrum, you have the ones who love ice cream, the exciting stuff, right? So those are the aggressive type. The aggressive investor, they're willing to invest in things that are very, very volatile, and the value they can wake up tomorrow and it's down 20% and up 50% the next day. In between, there's different groups of people. There's a majority of people somewhere in between. By the way, that profile changes, because when you're young and sprightly, you may be more exciting and adventurous and aggressive. But as you get older and you realize how the world really works, you get a little bit more conservative. So the different type of investors is also critical. So know what your objective is.
Know your objective.
Know the type of investor that you are at that specific time, aggressive, conservative, or moderate. And then, this is a key one, discipline. Stay disciplined, right? So the most successful investor, Warren Buffett, what he does, that's it. That's his secret sauce. He just stay disciplined. Find good companies, invest in those companies. And I was, you know, in prep for this, I was kind of just reading some of his work. One of his key things is, he doesn't watch the price of a stock. Why? Because he knows that the price of a stock is just reflective of what people out there think of the company, not necessarily what the core value of the company is. So he stays invested, and as such, over time, the thing works. The disciplined investor takes advantage of the guy who is going to panic and doesn't have a plan, because the minute he sees it falls, he's going to panic and throw away his good assets. And we, the disciplined investors, pick it up and stay the course.
I love that. And there are a couple of folks had discipline as their words for 2023. You know, Peter, I'm glad you raised the point, and Keisha said it too. And, you know, anybody who knows me and, you know, follows me on social media and listens to the conversations, I like to take off my JMMB hat more often than not. And when we talk about the fact that it's your money, I also think of even the mathematics of it, right? Because I know I have an advisor, I have an assigned advisor, and I know I am one of maybe 1,000 clients that are assigned to him. There's no way, physically, I know that he can keep up with 1,000 of us with our different risk appetites, different ages and stages of life to know, all right, Kerry, you buy this one, sell that one. All right, Peter, you do this. It's physically impossible. So what I've found, certainly for me over the years, is nothing replaces your own education. And that's why, you know, we're so excited when we see people investing in themselves by coming to something like this, because you're going to have to keep abreast of what's happening in the news. You're going to have to follow the companies that you invest in, whether it's stocks or bonds, what have you. So you can kind of get a sense of, okay, now is the time to stay the course. Here's an opportunity to take some gains off, going to sell some of my stocks. And yes, you can consult with your advisor just to make sure if you're not comfortable and you need to do your own thing. but nothing replaces it because it's just physically impossible for your advisors to do everything.
Exactly.
I know I love that my team is giving me a time signal. We're coming down to the final just under 10 minutes. But David, could you break down some terms for us? IPO versus APO. What are those things actually? A lot of people, because it's like anytime there's an IPO, everybody get hot and excited. And then now APO less popular, but it does happen every now and again. What are those things exactly, and what does that mean for an investor?
I think if I got preference shares, but that's another story. But
Yes,
yeah,
preference shares.
Yeah, so the initial public offering, is when the company becomes available to the wider public, right? So there are two scenarios that can happen. So let's keep it simple. Let's say me and Miss White over there, Miss Patrice White, form a company that sells roses, right? And let's say in scenario one, we want to grow this business, right? And let's say we're in 2023, right? Interest rates have gone up. We go to the bank is like, boy, we're not so interested, in lending this money unless we lend it to you probably like 13, 15%. The business can't afford to pay those kind of interest rates, right? So we look at option two, because there is money two ways, debt or equity, right? Equity meaning the interest you have in the business. So we each own 50-50 of the business, and we say, all right, let's grow the business. So the business, in this case the company, issues 20% of new shares to the public, and we get this, and let's say water is the money, puts to the business, and we have this flower pot right here, that flower pot right there, and everybody's happy. And our new investors or shareholders, they benefit from the company's price going up if it continues to perform well on the stock exchange, right? Scenario two, let us say Mr. White and I say, we've done so with this business. Let's sell part of it and monetize our investment, right? Let us say we each want to buy a Bugatti and buy next business. So, in that case, we would sell 10% each, take the money, and do what we want with it. So, those are the two examples that we are familiar with companies going public. So, for example, Image Plus Consultants Limited, which actually listed on the JSE yesterday, they raised $495 million by issuing new shares. Then you have Express Catering Limited, where the parent company sold shares and took those proceeds for themselves, and the company was listed. When it comes down to an APO, however, in that context, it's where a company is already listed and looking to raise additional equity capital. So you have right to issue APO. The thing is, in the case of APO, it is open to the public as well. So this term isn't necessarily Jamaican. It comes to Trinidad, considering that JMMB, is cross-listed on both the Jamaica Stock Exchange and the Trinidad and Tobago Stock Exchange. That's why you have to carry that term here to Jamaica. And in context, what happens is that the company says, hey, we need to grow the business further. We've called our biggest shareholders, and they're like, we can only commit so much and no more. So the business has to grow. And I mentioned, debt is one option, but debt has constraints. You have persons in the public and other potential strategic investors who might want to come onto the business and be like, we want to join you. So you have this APO, and anybody can buy in, basically. The one constraint to an extent with that is it introduces a lot more liquidity, or in this case, shares being into the public, which sometimes can depress the price in the short term, but it doesn't necessarily depress the company's long-term prospects once the funds are appropriately used. When it comes to preference shares are just about both IPO and APO, because in both an IPO and APO, you're talking about new ordinary shares being listed, right? So on the capital stack, you have debt, then you have ordinary shares at the bottom. Debt has a finite return, but low risk. So she's kind of like a immaculate girl, we get the law degree and everything, and she's earned that money, and she's happy. Then you have the ordinary shares, where it's like a JC guy like me who goes to...
I wondered which school you go call.
Everybody's laughing, isn't that good?
Sponsored.
No, but still. So ordinary shares are like me, somebody who has a lot of potential and has a lot of unlimited return, but I carry a lot more risk. So in case of preference shares, you can call, let us say, your AISK students. It's just an example. I'm just using a simple example. So,
fair enough.
So they don't get to vote in the interest of the business. Or when ordinary shareholders can do that, they get paid before I do. So I'm at work, but they have to get paid first. And the thing is that in that case, there are special privileges. So in the case of listed securities, preference shares are usually used like a debt instrument, hybrid debt instrument. So, for example, I buy a preference share, I bought preference share the other day, and I bought for 90 cents. If I buy 100,000 of those shares at 90 cents, that's $90,000, right? This preference share matures in March, meaning that when March comes, it matures at $1. So my $90,000 was what I invested, and I get back $100,000. So I made $10,000 gain. And there's also the interest that had been paid as well, which should have been about 2.25%. So I hope that kind of simplifies things for everybody.
So initial public offer or offering, as it were, is when a company comes to the market for the very first time to offer shares to members of the public to buy. And that's what people get excited about most times. Additional public offer is for those companies who are already public, and they're offering more shares to the market for more persons to buy shares in the company. And then preference shares, still shares, but basically they don't really have the same voting rights. But if, God forbid, anything were to happen to the company and the shares would need to be paid out and stuff, or bought back anyway, whatever, the preference share people get paid first than the ordinary shares. So pluses and minuses, right? But thanks so much, David. But I just got a time signal from my production crew, so we're really coming down to the wire, and I'm going to leave my last question with the lady. But just to make sure that we're clear, right? So we know investing, different from saving, carries a little bit more risk, in some cases a lot more risk. There are different types of investments. We encourage people to have a basket of investments in their portfolio. Which investments you choose is based on how much risk you want to take on and your age and stage in life. To be able to know that, it's good to speak to your financial advisor, a financial advisor, to break down the different types of investments and which ones would be right for you. Make sure you stay disciplined, add the money over time and stay consistent. And of course, make sure that you do the learnings for yourself as well. Make sure you are knowledgeable, you understand what you're in. And if you don't, then get the information that you need. Because at the end of the day, as Keisha said, is your money, is not the investment company's money. Right. Very, very important. Now, Keisha, I'll leave the last question to you as we wrap, last minute to 60 seconds. What would you say is the last bit of advice you'd give to anybody who wants to win in their wealth building or investing strategy? What should they bear in mind to win if they want to win in their wealth creation strategy?
As I said, everybody want to be a winner. Winning important. Winning would mean you meet the goals. And how you meet the goals is consistency, being in the right type of investments. If you don't know what the right type of investments are, that's okay. You have the advisor, you have Peter and his team of 500 people who are experts at doing it if you can't do it yourself. The number one thing to make sure you win is to be consistent. And if you know you struggle with consistency, automate the consistency. That is the key. Set up a standing order, pull out the money first as you get paid, and make sure you contribute to your wealth building first. That is the key thing. If you are regularly doing it, you must win. You can't go wrong. Where people fall down is that they just fall off the boat. They're not consistent. But if you stay consistent, you must win. In growth type investments, we need that type of investment as well. If we're thinking about our kids and investments for our kids, we have to start early. With my son, as him eye open and start ball, next day we opened his investment accounts and we started putting money each month into that account. We know just by starting from him, that little young, tender age, by the time he's 18, he's going to be a millionaire in US dollar terms because we stick to the investments. We automate it so we don't have to think about it. If you're building generational wealth that will live past you, you start early. You go into more growth type investments. Peter and his team of 500 persons can help you to that team of advisors to say, these are different types of growth investments that are there. That's what you'd want to think about, because growth is what will allow the money to grow past you. So even when you're not here, your money is still alive and flourishing for the future generations.
Thanks so much, Keisha. All right, any more questions? We have standing mics, guys, and we also have floating mics for those of us who have little arthritis in the knee. All right, see a lady in the back here.
Morning, everyone.
Afternoon.
I have a quick question. Okay. So, forums like this I can appreciate because you learn a lot about investment.
Yes. Yeah.
But let's be realistic. We know what's happening in the news with both. And persons been talking with my friends and we said, no, we're not going to invest because we don't want them to take our money, and I bet I'm going to take it out and put it in the bank or under my bed. You know, so it's a buzz going on. So as someone that want to put their foot in the water or dip the toe in the water, what advice would they give to me? Because I'm a bit confused now or hesitant. I'm scared to invest because I don't want my little change to be gone.
So can I tackle this?
Excellent question. So I'm going to invite Peter to talk about, because I think it's important for us to talk about the difference between saving and investing in the context of deposit insurance and those sorts of things, because not many people understand the difference. But I'm glad you raised a point about Bolt, because it's important to remember, I mean, it's all allegations right now, lots of investigations happening. But it would seem as if, because I don't want to talk out of turn, it would seem as if there's a case of employee fraud that took place at another institution. And I can say that certainly from JMMB's perspective, we've been in operation for 30 years. If at any point there would have been any employee perpetrated fraud, the customer was restored, right? No customer should have to suffer a loss because of an employee's actions. So, just letting you all know, that's JMMB's position, okay?
Right.
We're just going to break down now.
Right.
Step by step.
Deposit insurance versus, but we just put the employee fraud thing
Right.
to bed, okay? You're good. Peter.
All right. So let's talk about it. So first, we mentioned difference between saving and investing, right? So the saving part of it, your money is in a bank. The bank is regulated by BOJ, and the bank has insurance against going out of business. Because technically, as I said, you're lending your money to the bank. If the bank should disappear, there's deposit insurance behind that to ensure that you get back your money. 1.2 million and below, you're going to get back your money easily. But even before it reaches anywhere close to the bank going out of business, there's a whole layer or structure set up to protect depositors from losing money. So banks, we move them to one side. Investing, we've mentioned it throughout this thing. Understand what you're investing in. When you're investing money, you're buying an asset. That asset is yours, all right? So if your money's in a unit trust, that unit trust, let's call it an equity unit trust. That unit trust is an independent entity from the institution. Let's use JMMB. So with or without JMMB, the unit trust will exist. And as such, when you invest in that, your value changes when the stocks in that portfolio move up or down. Not anything to do with JMMB at all, right? So Kerry spoke about it somewhat in that this case seems to be where somebody, allegedly, literally stole money from client's account. That's what they did, or that's what she did, allegedly did, right? So that is not an investing risk, right? It's a fraud risk. You could put your money on your mattress and somebody pinch the money dollar, right? Because that's fraud. That's not investing. So that's not the risk associated with investing. That's the risk associated with fraud. Now, institutions have a mechanism put in place to restore clients when an employee steals money from client accounts, right? So if it's something that happens globally, right? So I'm not even saying that. People are people. It happens globally, but institutions recognizing, okay, oh, this is our fault, they restore the client's money. End of story.
Yep. Kerry,
Indeed. Thank you, Peter. David, you wanted to add into that?
so there's a serious level of concern, and to add context to that, persons should understand that, for one, if you buy stocks, it doesn't matter if it's JMMB, the next broker, or around the corner, those stocks are held with the Jamaica Central Securities Depository, and if any other jurisdiction, it's held with a custodian. So, if your broker goes out of business, you are fine. You can transfer your assets, or in this case, your stock portfolio, to another broker, and your life continues. That's the first thing. And also, the Jamaica Stock Exchange has a compensation fund in the case a member dealer, such as JMMB has some kind of event. I won't get into certain things, but there's an event, and it's proven, and the JSC board agrees, they will compensate you. That fund is about $900 million. And to further add on to that, I understand the fear and the situation surrounding the whole situation of the alleged fraud, but in the same breath, we also need to remember that if you put your money under the bed, not even necessarily something to get the money out is going to be the quote-unquote fear, but that money is getting less and less each day. So, money has to find a home. We all have homes, we all sleep at night somewhere in a bed or something. Money has to find a home, and that money has to grow. So I understand the concern of saying, I don't want to invest because of what's going on right now. But the reality is, this is where you should be thankful, in a sense, where your broker, for one, sends the monthly statements. You can actually contact the JSC or any custodian and say, are these things that my advisor or broker tell me in my actual portfolio? You can check on JSC's website. You have JTrader Pro. There are different mechanisms to check. And the thing is that even in the case of Bernie Madoff, you could contact the NYSC or the different stock exchange and say, hey, is it actually there?
Yeah, there is that. Because if you're investing in stocks, a lot of people don't realize that in as much as you're going through your broker, like maybe at JMMB, you can actually go straight to this Jamaica Stock Exchange to corroborate what JMMB say in terms of stocks that you have. So wonderful checks and balances. So guys, thank you for that context. We have time for 2 more questions. I want to take a question from our online audience. We now forget to know, because we have the questions here. And actually, there's one question that's most popular. I'm going to turn it to Keisha, and then this lady, beautiful lady here. Don't move, you hear? Don't move. If you want, cut somewhere, because we're going to get your question second. But we're just going to take her online because we can't leave out with online people. And then we'll have your question, and then we'll wrap the Q&A for now. Keisha, could you explain what is a unit trust, please and thanks? Because not everybody really understands. I know I didn't understand until I started to work in finance. So what is a unit trust, how does it work, and who is it for?
Right. I'm going to bring in back our trusted friend here.
I'm afraid of that.
That's what you do. So when we think about unit trust, it's a fund, they call it, or collective investment scheme, but it really means a group of investments are inside the fund. And someone, a professional, manages the fund for you on your behalf, a skilled person. So unit trust can have in there some stocks, it can have some bonds, there are some of them that have real estate inside of there, but it's collectively pooled and managed by a professional on your behalf. Unit trusts are really good for persons who don't really know the ins and outs of stocks, or they can't really do the fundamental research themselves, but they still want to be able to invest. Those persons are good candidates for unit trust because you have a professional who is doing the work for you. And if the professional is not doing the work, you can go and ask the question, because whose money is it? Right.
All right. Just to add to that, right? So just to throw you on the level of security. So yes, there's a professional managing it.
Right.
But the structure is, so the unit trust is a trust account, meaning there's an independent entity set up that is independent of JMMB. All the assets of that account or trust is in the name of an entity that JMMB can't control.
Right.
So my job, or my team's job as a manager, is we get to make a decision what to buy, what to sell, what to put in, what to take out of that. but we're buying it in the name of the trust or in that independent entity. So whether or not JMMB exists or not, the money is safe. So all the assets in the trust, the unit trust, are in the name of an independent entity. Now, the value of the unit trust changes each day based on the value of the things in there. So I pool everybody's money together. So it's excellent for small investors, adding on a monthly basis. We pool that money together, and then we buy big things. We buy a building. We buy a lot of stocks. And the returns from those stocks or those buildings goes to the trust. We take our tiny little fee, and then the rest goes to the investors in the form of a price. Right. So that price changes every day based on the value of the assets in it. Now, over time, so while you may see it going up and down, over time, the trajectory should be that it's going up. Because if you're buying good companies, the companies are going to continue to pay strong dividends, they're going to grow their profits. Eventually, the market will realize that, oh, this stock is valued a lot more. And in the case I have, NCB was once selling for $4 a share, right? In our lifetime, right? Yes. And as such, so the ups and downs, things go up, things come down, but if you stay disciplined over time, the thing work out.
Yes. Love it. Thank
you.
you.
One final quick point on 10 seconds. So it also gives opportunity for assets that you can normally access. So you have real estate development unit trust now, you have bond unit trust, you have money market unit trust, things you can't get access to. So that's one of the benefits as well.
Yeah.
Good
Thank
point.
you so much, David. Madame in the beautiful white shirt, thank you for your patience. Could you pop up there for me and give us your question at the mic? Give us your name too. We like names. We want to know your name.
All right. So my name is Jada.
Hi, Jada.
Hi.
Hi.
I wanted further some expounding on the difference between the preference and ordinary shares. How does that work?
So, all right. So
Difference between preference and ordinary share. I know David, could you just give like a quick 30 seconds? Because I know you had touched on it earlier.
So the ordinary share, you have the voting right. So if you go to AGM, annual general meeting, you can vote on matters. When the company makes a profit, part of that profit can be paid to you as a dividend. And also, in the case of that ordinary share being listed and the value changes, you benefit from that. So your ordinary shares, your upside is limitless. There's no limit or ceiling. With a preference share, it's usually a defined lifetime, meaning that it's expected to mature one day. So you don't have voting rights, but at the same time, you have to get paid dividends. So if JMB, for example, doesn't pay a dividend, the preference share guy has to get a dividend. That's a must. And on top of that, the preference share guy has that right in the sense that if, let us say, a business goes out and your debtors are paid and your preference shareholders, they get paid before the ordinary shareholders. So the preference guys, anything happening in the world, they have to get preference and priority first before ordinary guys.
Thank you, David. There's a lot of folks here online. Big up the online folks. Love on. There a lot of questions came in about unit trust, but also about EFTs.
ETFs.
Okay, because they said EFTs. I'm just making sure I'm not, my glass is working right. But ETFs, what's the difference between ETFs and unit trust? Keisha, could you, or Peter, whichever one?
All right, let me start. So ETF, exchange traded fund.
Funds, yes.
So this is testing. Oh, so this is a mutual fund that is listed on a stock exchange. So there's some legal difference between mutual fund and unit trust, but both of them are collective investment schemes. We're pooling the money of small investors together and their entities. An ETF, exchange traded fund, meaning that it's listed on an exchange and the price of that ETF changes based on market sentiment and so I can go on and put up a bid to buy an ETF, try to get the ETF at a particular price. There's no guarantee that I'll get it at that price. There is a price that it's based on what somebody's willing to sell that ETF for. So a ready buyer at one price meets a ready seller at that same price, we meet. That's an ETF. So the value of it changes, and you have ETFs for stocks, bonds, or different type of asset class. The difference between the ETF and the unit trust is that the unit trust does not trade on an exchange. So the value of the unit trust, the price or the value of it is dependent on the value of the underlying things in it. So if you have 10 stocks in there and those stocks, the weighted average price of it is $1 a share, when you want to come out, you're coming out at that price. You're not dependent on what the market or someone believes it is valued. You're coming out at what we call the net asset value, which is the fundamental value of the thing. So it's possible, very, very rare, but possible for an ETF to have a price that is different than what the weighted average value of the things in the ETF are at. So an ETF seems more volatile than a unit trust because the unit trust value, the manager has to take you out, has to redeem your units at a agreed price, as in the NAV price. The ETF, to come out of the ETF, you have to sell it to somebody else on the market. And we all know, depending on if people are panicking, the price that they're willing to buy stuff at will fall if there is uncertainty.
I think the natural question is examples, because a lot of people hearing this for the first time. So
Black
examples
Rocks.
are ETFs.
An example of an ETF is the S&P 500 ETF, the most popular one. So
You have SPY, you have XYT, you have all the
Overseas.
yeah, so these are all US dollar overseas, predominantly on the US stock exchange. So the closest one that comes to it locally, right, is we do have a fund, an index fund, not legally not the same like as an ETF, but it captures that element of it. You have a financial index, a traded fund. That fund, the price of it changes based on what people think it should be valued at. But the fundamental value of it is that it should be the price of everything in it, right? So those funds listed on our exchange, not really an ETF, the financial index, the manufacturing index, but it's the closest thing to an ETF in Jamaica.
Love that. And you know, I'm glad this question is raised because a unit trust is a great starter for an investor who is just starting out. You only need like a couple $1,000s to start,
Correct.
right? Jamaican dollars, not US. Couple $1,000s to start. It's a great investment. There was a question here online as well about even investing in real estate. Somebody said, boy, them say invest in real estate, but me not have no millions of dollars to do that. But the reality is that you have unit trust.
You have a unit trust for that.
That is invested in real estate for you. So all you really need to go in is with a few $1,000s as well.
Correct.
To participate in a real estate investment through the unit trust. It's just really wonderful that there are these opportunities there. Guys, we're also acknowledging the questions online because at the end of the day, we're going to try to get to the questions. And also to remind everybody, guys, this session or all the sessions today are being recorded. And the good thing about that is that when they're recorded, we're going to put them up on YouTube in a nice public place. You can take out your popcorn, your glass of wine, watch it on demand, share it with family and friends, and kind of go over some of the things you may have missed. Because I realize some of the questions coming in, we would have probably discussed it. So maybe depending on when you join us, you would have probably missed that. So just to let everybody know that we're recording and you can go back and watch everything again. There's this question here about knowing which stocks to choose. So we're not going to tell you which stock to buy on this stage. So sorry, people. So sorry. Because that will get us into a whole lot of trouble for many different reasons. But there are some fundamental things that I think investors need to bear in mind when choosing which stock to buy. Keisha, could you kind of just kick us off in terms of how do I know what are the things I should bear in mind when I'm choosing which stock to buy?
So when you think about the stocks, come back to the goal. Always come back to the goal. What do I want my money to do? And then can this stock help my money to get there so it can do what I want it to do? When we're analyzing the stock, we need to look to make sure the company will survive, because we don't want to become an owner in something that shut down next week and we'd lose our money because we're an ordinary investor. We don't want that. So we have to first understand what we're buying. We want quality. What does quality mean? We want to make sure the company will exist into the foreseeable future. We want to know that the profit, when we look on the income statement, the bottom line keeps growing because profits grow share price. So we have to see that the profit keeps growing so the share price can grow, so our money can grow, so we reach the goal. We want to make sure that if we want dividends, we want to look at the track record of dividends from the company, how often, how much they pay, look at the quality of leadership of the company. The people who run the company must know what they're doing so that they can keep making money, keep making profits for you. Those are some of the things we look at. I'd say the top stuff.
Yeah, and to that point, right? If you remember, you're buying a piece of a company. So you would not just willy-nilly throw your money and buy every single company that exists. You're going to look and say, okay, is that company making money? So, or what is their business model? How do they make money? Will they be able to make money continuously? So there's a company, some of you, depending on your age, may not know it, called Blockbuster. That was a company that you physically walk in and rent DVDs. So the millionaires in here wouldn't have a clue what we're talking when we say DVD, right? But there's a company,
Cassette, VHS.
that you physically walk in
video
and rent. So if you want to watch a movie, that's how you did it. You take taxi, take bus, and you go there. You pick it up, you pay them money, and you come back. There was a company called Kodak that used cameras. You take the camera and you flash it. That's how they exist.
Polaroid.
So think about it. Somebody bought Kodak shares and Blockbuster share thinking that this company would exist forever. But things change. The technology, the business model change. So when you're buying a company, you need to look and say, okay, what does this company do? Do they have a competitive advantage? Is this where the world is going? What do they do to make money? And if you don't here's a quick thing. If you don't understand how they make money, it's probably not the company for you. Also, the company, you are, as David pointed out, the ordinary shareholder is like, I call that the last residual guy, the guy who holds the bucket. So you are the last person out as an ordinary shareholder. So you need to ensure that this company will exist. Will this company exist in order to create that generational wealth that I want, right? So you have to do your homework. So the job of buying a stock is not just willy-nilly, my friend say it, or the gas pump attendant say, yes, this is the next hot thing. You have to understand what you're buying. So that is why the team, you have to build an entire team, the infrastructure for analyze. If David knew all the hot stocks, he would probably be somewhere on a Caribbean island right now.
I am because in a Caribbean island.
That he owns, I should point out, right?
That one.
So understanding the fundamental thing about a stock, you are buying a company. If you don't know how the company make money or how it will continue to make money, then you have not done the work necessary to buy a stock. Anything else, there is hope and pray.
Kerry, just one kind of comment, kind of running short on time, but also the dividend yield that has not been mentioned because persons say, I buy a stock, I get the check and it's nothing. But did you check the yield? Because the thing is, a person might say the check might look little. Did you check the yield? Because for context, you talk about dividend yield, right? The dividends for the year divided by the stock price, right? So if a company pays $1 in dividends for the entire year, and the price says $10, that's a 10% dividend yield. In Jamaica, you have like a Carreras, a Trans-Jamaica Highway, a Mail Pack, which are paying dividend yields above 8%, meaning that if you invest $100, you get about $8 gross. Yeah. And there are stocks overseas, like I have one right now that gives me like 15%. And even when COVID hit, that was a golden opportunity for many persons who wanted dividends. So for example, you have a company called Simon Property Group. They own the premium malls in the USA. So your Sawgrass, your Aventura, all these nice pretty malls in Florida and all across the country, they own most of them. They are real estate investment trust. And their price went as low as $40. But the thing is, the business didn't change anyway fundamentally. And if you bought it at $40 and the dividend has returned to call it pre-COVID levels around $6, that's a 15% dividend you locked in just by buying that nasty dip. So that is why I said dividend yield matters for those who are considering dividends, because you have a company that might be cheap, might be $1, but it seems like be 1%. versus a company that might cost you $100 but pays you 10%.
Right.
And that is why it matters.
Very
Think about
important
that, I
point.
agree.
So thank you so much, guys. And again, folks, you know, this could go on for a
Yeah,
couple
There's
of
one more
hours.
person up there.
There's one more question. I'm getting the time signal. Sir, could you ask your question, please, real quick?
All right.
Go ahead.
I don't think it's on.
No, just speak into the
not on.
mic.
Just go ahead. I don't know if they'll switch it
Hello,
on.
hello, hello.
Yeah, go ahead. We're hearing you.
Quick question. I just wanted to know when analyzing a prospectus, what are the key things that you look for to consider whether or not the company is worthwhile investing in?
So it's very similar to just
It's a follow-up question basically.
Yeah, so it's the same kind of thing where Peter just speaking to how do you determine what stock to buy? It's the same thing because that's what you're doing when you're analyzing a prospectus is determining whether or not you're going to buy this particular stock in a company. And so we're going to ask that you just go back and look at the recording because I'm getting the time signal. But yes, it's just what Peter said. Those are the things. When you're looking to buy a stock, and you're looking at the prospectus, those are the questions you need to ask yourself to determine whether or not this is a stock for you. Love the questions, guys.
Yes, yeah.
Again, folks, for real this time, can we give our panelists a round of applause? Thanks, everybody.
Oh, come on.
We're going to take a picture. Me must be in the picture too? Okay, I'll take off my glasses.